In the era of high inflation, every person wants to invest money in such a place where he can earn good amount of return. The interest on saving account is very low. Despite the increase in the repo rate, interest rates on fixed deposits, that is FDs, have not increased much. The stock market is undergoing a period of ups and downs. Meanwhile, investors, especially those with high salaries, are turning to tax-free bonds. So, let us know what are tax-free bonds and how you can earn higher returns than even bank FDs. So, what are tax-free bonds? Several public sector companies like NHAI, PFC and REC issues tax-free bonds. The capital raised through these bonds is used for funding infrastructure and housing projects. Tax-free bonds are a good option for those investors who want to stay away from market risks. These can also be included in your retirement portfolio. These bonds can be bought from the stock exchange. The government has issued these bonds between 2012 to 2016. The supply of tax-free bonds is limited as no new bonds were issued in the last 6 years. Now, let's talk about return on tax-free bonds. There is no tax on interest income of tax-free bonds. The yield on tax-free bonds has gone up to around 5.5% to 6% from 4 to 4.5% a year ago. While the interest rate in short-term bank FDs is 4.5 to 5%, so investing in bonds can be considered better than keeping money in a savings account or investing in FDs. Investing in tax-free bonds is less riskier as there is lower chance of any default in the principal and interest amount. Tax-free bonds of public sector companies have a AAA rating, which is considered very safe. Tax-free bonds are of longer duration. These bonds mature in 10 to 20 years. Tax-free bonds can be traded through demat and trading accounts. When government companies issue these bonds to the general public, the application can be submitted online or offline. Once these bonds are issued, they can be bought from the stock market just like trading of shares. Tax-free bonds cannot be broken before maturity, but it can be sold to other investors on the stock exchange. Tax is obviously levied on this trading of the bonds. Vivek Rege, founder VR Wealth Advisor, says that these bonds are beneficial for those falling in tax slab above 30%. But you will be able to invest in tax-free bonds only if these are available in the secondary bond market. The government had issued these bonds in 2012-2016 and after that no issue has been made. And it is not expected that the government would issue these bonds in the coming times. These bonds are available in large ticket sizes, for example 5 lakh rupees. These bonds can be bought only in multiples thereafter. If you are getting 5.5% tax-free yield, then it is a big deal for you.